In the Middle East, great fortunes are rarely stacked in vaults or flashed in headlines. They are engineered into systems, ports where fees never sleep, airlines that knit continents, dividends from oil wells and gas trains, football clubs that double as billboards, and sovereign funds that turn one-time windfalls into income that outlives the wells. The names on the door, Al Saud, Al Nahyan, Al Maktoum, Al Thani, Al Saba, are familiar. The mechanics behind the names are not. Tonight we open 7 doors. What you'll find behind them isn't a conspiracy, it's a set of playbooks that hide in plain sight. If you are ready for the full Al playbook story, kindly subscribe and turn on notifications so you don't miss our next video. It began with a simple, stubborn question: where does the money actually move? In this region, the answer often passes through a holding company or a sovereign wealth fund before it reaches the public eye. Think of those vehicles as national endowments and family flywheels. Oil and gas royalties, port concessions, airline profits, real estate leases and telecom dividends flow in at the top. At the bottom, patient capital flows out into airports, banks, data centers, container terminals, hospital chains, and yes, into city-making. The fortunes are hidden not because they are secret, but because they are structured. The House of Saud offers the cleanest diagram. Saudi Aramco, an industrial cathedral whose wells, refineries and pipelines throw off one of the world's largest dividend streams, sits at the headwaters. Those dividends help fill a sovereign vehicle, the Public Investment Fund. PIF is not a family piggy bank, it is a state balance sheet with family fingerprints on the strategy, pushing capital into giga projects at home and stakes abroad. Read it as a portfolio reweighting, reduce dependence on crude by building cash flows in tourism, logistics, sports, gaming and advanced manufacturing. In plain language, the country transforms volatile hydrocarbon prices into steadier rent from hotels, stadiums, industrial zones and data infrastructure. The hidden richness here isn't a suitcase of cash, it's a dividend machine that keeps funding tomorrow, even when the spot price dips today. A short drive down the coast, Abu Dhabi answers the same question with a triptych: Adiya, Mubadala and ADNOC. Picture Abu Dhabi as a 3-engine jet. Adiya is the long-haul engine, quietly compounding in index funds, real estate and infrastructure from Sydney to San Francisco. Mubadala is the strategic engine, venture, semiconductors, aerospace, life sciences, partnerships that come with know-how attached. ADNOC is the cash engine, modernized and modular, stakes sold in pipelines, drilling and chemicals to bring in partners and mark-to-market value. Over it all sits the Al Nahyan family's hand on the throttle, and one emblem the world knows by heart: Sheikh Mansour's City Football Group. Why would a hydrocarbons capital build a global football portfolio? Because brand is a network with cash flows, tickets, media, sponsorships, and because soft power opens doors that balance sheets alone cannot. Abu Dhabi's hidden riches are portfolio design and velocity. The ability to sell a slice of a pipeline on Monday, seed a chip foundry on Tuesday, and sign a player on Wednesday, each transaction compounding the others. Dubai took another route: ports, planes, and permission. DP World, Emirates, and a web of free zones created a city where time costs less. DP World's concession model turns long-term rights to operate container terminals into predictable fees and steady growth. Emirates turns geography into a hub-and-spoke printing press. Seats sold today finance routes tomorrow. Routes build the brand. The brand justifies next year's wide-body order. And the free zones, Jafsa and Friends, offer the frictionless back office, 100% foreign ownership, fast licensing, tax predictability. At the apex sits the Al Maktoum family's investment corporation of Dubai, where dividends from ports and planes mingle with cash from banks, hotels, developers and retail. The hidden riches here are speed and integration. Look at Dubai through a banker's eyes, and you see a single operating company with 3 profit centers: logistics, aviation and real estate, each one feeding the other. Qatar's fortunes are forged in the cold. At Ras Laffan, gas is chilled to minus 162 degrees Celsius, loaded into massive carriers and sold under contracts that stretch for decades. Those paper promises, sales and purchase agreements, turn volatile spot prices into predictable cash flow. The cash pays for new liquefaction trains and an even larger fleet, locking in scale advantages the competition can't easily match. The surplus flows to the Qatar Investment Authority, which behaves like a national pension fund. Airports, utilities, trophy assets in global capitals, stakes in banks and consumer giants. Alongside the balance sheet hums a carefully tuned engine of soft power, a media network, a university city, a football club in Paris, and a World Cup that turned Doha from a dot on the map into a destination. The hidden riches are not only the LNG volumes, they are the contracts and credibility that make banks line up to finance the next decade, paired with a sovereign hedge that keeps buying yield when markets are scared. Kuwait's Al Sabah family did something radical before it was fashionable. They started saving early. The Kuwait Investment Authority predates most sovereign wealth funds. It runs like a two-pocket wallet, one pocket for today, one for the future. Oil receipts flow in, but the mindset is bond manager, not speculator. Broad equity indexes, blue-chip properties, staple infrastructure. Conservative, intentionally. Kuwait learned the hardest lesson of all during war and reconstruction. A fortune is what you can count on in an emergency. KIA's hidden richness is time itself, the compounding that happens when a fund turns 10, 20, 50, then 70 years old. Quiet beats clever when clever cannot survive a shock. Not every great Middle Eastern fortune is royal. The Olayan family built a private conglomerate that spans consumer goods distribution, industrial services, banking stakes, and prime real estate. If you've checked into a marquee hotel in New York or London, there's a chance a slice of your room rate became an Olayan dividend. If you've brushed your teeth or rinsed your dishes in the Gulf, odds are a distribution arm earned a margin in the background. That is the genius of the old merchant dynasties. Own the middle of the value chain, and the money passes through your hands every time a product changes hands. The hidden riches are the annuities, the steady, boring cash flows that arrive in good years and bad, amplified by a global equity portfolio built quietly, rebalanced religiously, and explained to nobody. Contrast that with the Sawiris family of Egypt, whose wealth tells a different story, one of risk, reinvention, and range. They built networks in concrete and in code. One branch poured the region's bridges and towers, another wired them with telecoms, another spun fertilizer into cash flow, another dug gold out of the ground and listed the holding company abroad. They didn't just buy assets, they built ecosystems. El Guna on the Red Sea is equal parts city, testbed, and billboard. That openness to the world, listing in Amsterdam, partnering in Canada, hedging in Switzerland, makes their fortunes resilient in a way that pure domestic plays are not. The hidden riches here are options. The ability to move capital, list businesses, sell a stake, pivot sectors, and keep compounding in a country where cycles can be unforgiving. Step back and patterns emerge. First, almost all these fortunes learn to separate source from the store. Source is oil, gas, ports, planes, construction, cyclical, capital-hungry, politically sensitive. Store is the sovereign fund or private holding company, boring, diversified, and designed to survive. That's why a downturn at the wellhead shows up years later as a real estate purchase in another time zone or as a stake in a utility with regulated returns. Second, they learn to monetize intangibles, brand, trust, and time. A port concession with 25 years to run is a bond with cranes attached. A 27-year LNG contract is a pipeline made of paper. A team shirt sold in Jakarta is not just a sale, it is permission to sell the next thing under the same badge. Third, they mastered governance by architecture. When you put the airline, the airport, the duty-free, the hotels, and the developer into one family of entities, you don't have to issue memos. The cash flows teach the ecosystem how to behave. Along the way, they confronted trade-offs. Concentration in a single commodity creates risk no spreadsheet can wish away, hence the push into airports, logistics, and finance. Long-dated contracts protect you from storms, but also cap your upside in spikes, hence the blend of spot exposure and destination flexibility. Visibility invites scrutiny, hence the habit of letting operating companies speak while families stay out of frame. And the line between state balance sheet and family influence is narrow and often debated, hence the repeated point in this story: sovereign funds are state institutions with professional teams and public mandates, not personal accounts. The fortunes are family-shaped, not family-owned. What about the next decade? Expect scale to keep winning. Low-cost producers in gas and petrochemicals will lock in expansions that squeeze higher-cost rivals. Expect capital markets to do more of the heavy lifting. Partial listings of national champions that price assets transparently while keeping control in local hands. Expect soft power to matter more, not less: the airport upgrade, the sports franchise, the museum district, because convening people is a business model that hedges against the volatility of commodities. And expect technology, chips, cloud, AI data centers, to become the new ports and pipelines with the same thesis. Control the infrastructure that everything else needs, then rent access on your terms. If you're an entrepreneur or investor studying these families to steal a page, make it this one. Build cash flow engines before you build edifices. The ports, planes, pipelines, contracts, concessions, and franchises may lack romance, but they generate the predictable income that funds everything else. Then wrap those engines in a structure, public or private, that can reinvest without starting from zero every cycle. The rest is choreography, choosing the right partners, the right jurisdictions, the right moments to sell a slice, and the right symbols to carry your brand farther than your capital alone could go. The Middle East's power families didn't hide their riches under mattresses. They embedded them in institutions that pay rents nightly and dividends quarterly, in brands that sell tickets and trust, in paper that promises delivery for 25 winters in a row. They turned geography into hub economics, geology into sovereign endowments, and reputations into term sheets. If that seems mysterious from the outside, it's only because the most valuable assets here are intangible: patience, reliability, and design. The fortunes are not buried, they are working, silently, globally, and more often than not, right on schedule.